Okay, we've got China opening up, of course. That's the biggest story in the markets right now. How does that change the investing landscape looking ahead?
Pretty considerably, because I think investors now have an opportunity to really make profits in three different ways. Number one, they can make profits in the reopening of China. Markets have gone up, but they have a lot more room to run as this sort of, turns from a market story into an economic story. The second opportunity for clients is to really focus on bonds. With yields being as high as we just heard, this is a great time to buy bonds, because if you can capture 5 or 6% yields, if those yields go down over the next couple of years, you're going to make money in a couple of different ways. And ultimately, with the U.S. heading into a potential recession, which we think is a high probability, and the yield curve certainly supports that, you'll have the opportunity, if you're an investor, especially in Asia, to actually re-enter the U.S. market in 6 months' time or abouts, and really have a third go at that. So if you think about this as an investment environment, it's very different than the environment we hear about when we're dealing with today's news about inflation or the Fed.
You didn't mention China there, though. I mean, you've got headwinds. I mean, it's going to be reliant really on whether China can have a sustained recovery from this, too. That's going to be absolutely vital.
Right, and you need a bunch of things to do that. You obviously need a good COVID policy reopening. You need consistent government policies regarding stimulus and regarding letting the free market, take its course in China, which seems to be coming back. But all of these things together could really trigger a very significant reopening. Remember, we have the evidence, right, in terms of what happened in the States and in Europe after COVID. You talk about extraordinary amounts of travel, people going back to different spending patterns, and all of that is still ahead for China right now.
David, is there too much optimism in the stock market? I mean, I find it hard to buy into it. Even if CPI does come in weaker than expected, suggesting that inflation is easing somewhat, it is still at about 6.4% or thereabouts. I mean, this is a high inflation environment. There are risks out there. How do you hedge against all these risks?
It really depends on what market you're in. I think the largest risk today, right, is in the U.S., where we have to see markets adapt to the fact that corporate earnings are going to go down. But take a look at last year. In 2022, markets were down roughly 20%. But if you take a look at earnings, they were at a peak. This year, markets could go down initially a little bit more, maybe 5 or 10%, but earnings are also going to go down. We've taken a lot of look at data for going forward. And after a mild recession, you can have 1 or 2 year returns that run from 25 to 50%. So this is going to be a reset for the U.S. markets. And the other thing that people really aren't listening to is that there are two types of inflation. One is lagging and one is leading. The lagging economic indicators, which are associated with wages, are still high. But the leading economic indicators, when we take a look at the price of goods, the price of commodities, the price of many of the inputs, including ultimately real estate, those are already falling. So a lot of the data that we're talking about and a lot of the data that the Fed is focused on is in the rear view mirror. It is already clear to us at Citi Global Wealth that inflation is coming down materially, and that we have to obviously pay attention to that, because that ultimately would cause the Fed to reduce interest rates in the near term, in the medium term.
Will this year be different for emerging markets after two lackluster years? I mean, they're off to a fantastic start.
Yes, I think that emerging markets will ultimately be the beneficiaries of this. Although that rally, I think, is going to come later. Once the dollar begins to fall and interest rates begin to fall, I think you're going to see an enormous opportunity for increased profitability in many of the major emerging markets. And they're going to be beneficiaries, of course, because they're going to become, once again, the lower cost producers of goods that are going to be purchased in 2024 and 2025. I always like to tell clients, and people who are investors, that the market leads the economy. And so right now, markets are very strong here. They're weak in the United States. But ultimately, in order for this global slowdown to actually pass, we're going to need to see market activity indicate that it's 6 months out. And I think that could occur probably in the third or fourth quarter of this year, when you could have a substantial view into 2024 and a general growth in the global economy led by China and some of the emerging markets, and of course a recovering U.S. after the recession actually begins.